The free look period provision for the National Life Insurance Exam is a mandatory clause in most states that grants the policy owner a cooling-off period after they receive their new life insurance contract. On the exam, you must remember that the clock for the free look period begins exactly when the policy is delivered to the owner. This is the most common area where students lose points, because the exam will try to convince you that the period starts on the date of the application or the date the policy was issued at the company headquarters. If the agent delivers the policy in person, or if it is mailed and received by the applicant, that is the official start date. If the owner decides they do not want the policy for any reason at all, they can return it within this window and receive a full refund of all premiums paid. There are no exceptions to this refund rule, and the insurer cannot withhold money for administrative costs or for the cost of the insurance coverage provided during those few days. The standard duration for a free look period is typically 10 days for most individual life insurance policies. However, you need to be very alert for questions involving policy replacements. When a client is replacing an existing life insurance policy with a new one, the law often mandates a longer free look period, such as 20 or 30 days. This extra time is provided to protect the consumer from aggressive sales tactics like twisting or churning, and to give them more time to compare the two policies side by side. Similarly, if you see a question regarding senior citizens or products like Medicare supplement and long-term care insurance, the free look period is almost always 30 days. Senior citizens are considered a protected class, and regulators want to ensure they have an entire month to review the details or consult with family members. Annuities also frequently carry a 30-day free look period, especially when sold to older clients. Another critical point for the exam involves what happens if the insured individual dies while they are still within their free look window. As long as the policy owner has not already sent the policy back for a refund, the insurance company is legally obligated to pay the full death benefit to the beneficiary. The coverage is considered fully active from the moment of delivery, despite the fact that the owner still has the right to cancel it. The exam may try to trick you by suggesting that the policy is in a pending status, but that is incorrect. It is a fully executed contract with a specific right of rescission. To keep these rules straight in your head, use the mnemonic, "Receipt starts the retreat." This reminds you that the act of receiving the policy is what triggers the time frame, and that the owner has the right to retreat from the agreement with every dollar returned. If the question involves a senior or a replacement, simply remember to extend that retreat period from 10 days to 30 days. You should also watch out for the term constructive delivery. This occurs when the insurance company gives up control of the policy by mailing it to the agent or the applicant. Even if the agent hasn't handed it over yet, if the company has legally delivered it, the free look period may begin depending on specific state laws, but usually the exam focuses on the physical receipt by the owner. Always look for the answer that provides the most consumer protection, which is a full refund and the longest applicable time frame. The free look period is designed to build trust in the insurance industry, and by knowing these specific dates and refund requirements, you will be well prepared for any variations of this question on your licensing exam.